If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
What's going on, everyone? I'm Shawn Winslow, and this is the Multifamily Money Podcast. Welcome back to another Finance Friday episode. Every Friday, this is where we dive into personal finance tips, tricks, and strategies on how to get your money working for you harder and smarter so we can create those lives that we all want to live. As we all know, it's not what you make, but what you keep. And today is talking about strategies on how to keep more, specifically when it comes to taxes, right? How to keep more of your hard-earned money, specifically when it comes to businesses. So I'm going to take an angle from, if you are a business owner. So, and also an angle of real estate business. So the way I'm looking at it is from like a personal standpoint, right? I own a business that invests in real estate. Both, I have multiple businesses, a couple that invest in my personal portfolio, and then a couple that syndicate. So Greenbrier Capital Group that specifically syndicates and buys much larger assets that bring partners with investors, and we buy value add multifamily apartment complexes across the country. These are value add deals where we come in, we're going to fix up the place generally over 5 to 7 years. We're going to come in, reposition it to get rents up to market and force that appreciation, and then usually either refinance or sell. And so I'm talking about what you can do as a business owner to lower your tax burden, thereby having more money in your pocket to go put it back to work, into real estate, into your business, whatever it happens to be. Because as we all know, time value money. It's more powerful in your hand today than in the future, especially if you can put it into a great investment. All right, so let's talk about, I'm going to go over 21 different tax write-offs for small businesses. So just envision yourself starting out your business, or maybe you've even been up and running for a year or so. And this is good for sole proprietorships, LLCs, such as C corps, S corps, partnerships. So this is going to be good for all of those. And the first is startup and origination costs. And the caveat to this is technically it's not a tax deduction, but it does offset your taxes. And that's because they look at it as a capital expense. The IRS looks at this as a capital expense since you're investing it into your business and the money hasn't actually left the business. It was just, transferred into an asset per se. And these typically occur over several years. So they're like amortized. And so you can take so much every year. So that's number one, startup and origination costs. And a lot of people overlook this. If you're starting a new business, make sure you're not overlooking that. You can, technically deduct that money. Two, this doesn't really pertain to most, real estate investment companies unless you have some type. It's certain businesses you do if you're holding inventory, maybe for value add projects, but inventory, you can write off, a portion of your inventory, and that's your cost of goods. And so the way you would calculate that, you take into account, the cost of the actual material plus freight, cost to store it. So if you have a warehouse, any direct labor cost from if you produce the inventory, or if there's labor to, move it, into place, into storage, and then the overhead of the building itself. So all those can be, deducted from your business, that the cost of the goods if you do have inventory. But then again, most of us probably won't have inventory if you're traditional, just straight real estate investment business and you're not vertically integrated, say with a construction management arm. Number three, utilities. So these are utilities to run your business, right? So think like water, electricity, trash, telephone bills. However, if you do have a home office, it's a little different and you use a landline The cost of that first landline is not deductible, but if you have subsequent landlines, you can deduct those. And then just another thing on a home office is that if you do work from home, you can either deduct a portion of your rent or mortgage, interest, property taxes, including homeowners insurance and utilities based on the percentage of your home you use for your home office. So say you use like 10% or 5% of the house, you can deduct that. Or you can they have a simplified method, which you simply deduct $5 per square foot of your home office up to 300 square feet. So that's a maximum deduction of $1,500. So do keep that in mind if you do have a home office, that you can deduct that. Next is insurance. And this is like, some source of business insurance on your entity, right? And this can include, business owner's health insurance, business continuation insurance, business owner's policy. They're 100% deductible. And then, property insurance actually can be deductible. So can liability coverage, malpractice, workers' compensation, auto insurance, business, and so forth. But do note that with health insurance, a small business may also qualify up to 50% tax credit under the qualified small employer health reimbursement arrangement. They call it QSE HRA. So do note that. Next, I know, guys, this is fun stuff. Stick with me, but it is important, especially if you're just starting out creating, an entity. This stuff can save you a good amount of money, so then you can go buy more properties or go whatever your business is, go reinvest more into it. Next is property rent. So say you're renting out your office space, you can deduct the lease or rental payment from your taxes. Auto expenses. So probably a lot have heard this. You can actually deduct, a lease payment, right? So if you lease a car for your business, you can deduct that. You can also, deduct expenses if you say you own the car and it's not a lease, such as, they give you a mileage rate, which is currently 0.58, so 58 cents per mile. And then if you use it for both business and personal, you have to divide it based on your actual mileage used for business. Now you might be asking, well, that's a lot of work, to know when I'm in business mode and when it's personal mode. Well, I use an app called Mile IQ to do this. You simply, it's always, running. It can sense when you're, going at a speed that would be, your car. And then it senses when you start, when you stop, and it tracks it. And then it pops up and asks you about that trip. Was it business? Was it personal? And then you just slide it either way, to the business or to the personal. And then it keeps it in the app. And at the end of the year, you simply just download it and you can send it to your accountant. Super easy. And that's how I track it. And yeah, I would highly recommend using that app if you're not already. It's one of those things, just automate whatever you can, and so then it allows you to focus on the stuff that's actually going to move the needle on your business and your pursuits. At the same time, this is still very important, right? Because we want to keep as much as we can so we can then reinvest in our business. But use stuff like that, like Mile IQ, to automate it. Next is depreciation on equipment and machinery. So think like trucks, heavy equipment. It can be even just be a lease, or you can outright purchase this. You can use depreciation against these to deduct. And traditionally it was over several years. There is a Section 179 deduction, which allows business owners to deduct up to $1,020,000 from new or used property and service during the tax year. But also, as we all know, there's something called 100% bonus depreciation. And for instance, let's say we buy a vehicle that's 6,000 pounds or more sure you've all seen this over social media. It's pretty popular now. You can go buy a G-Wagon, right? And 100% bonus depreciation, right? Well, I do want to note that this is the last year that you can get 100%. And this includes for real estate. So when we're buying, multifamily apartment complexes, in this year, we can currently take 100% bonus depreciation year one. Next year, that's going to go down to 80%. So if you're thinking to buy any type of, truck or vehicle like that or heavy equipment, I would do it this year. Obviously, don't do it if it's not something you've been planning on doing or really need. But if it has been something you've been planning on, do it this year because you get 100%. Not that 80% is terrible, but why not get 100? All right, next. These next two are I feel, or next three, actually, four, are stuff that I feel like people really never think of. One, office supplies. Why would you think that? But you can. So think paper, pens, paper clips, all that stuff can be deducted. And then office furniture. This can be deducted as well. And what I've seen a lot of people do is at the end of the year, they're looking at ways where they can reduce that tax burden. And I'm just saying, just go out and buy really nice office furniture just so you can do that. But if it's something you've been looking to upgrade or you really need a desk, a chair, whatever it happens to be, not only are you going to be able to upgrade it and get that item you need, but you're going to be able to deduct it, which is awesome. And then also next is a software subscription. So if you need some type of software for your business, that's a write-off. Advertising and marketing. This is, a lot of people don't realize this is also a write-off. You can claim back any money spent on ordinary advertising and market purchases. This can include things like billboards, business cards, yellow pages ads, as well as any freelancer design a business logo or sending thank you cards to clients, any type, and mailers and all that stuff. And then obviously what we do, a lot of people do direct to seller marketing, right? So those mailers, that's advertising, that's marketing. You can deduct that. Business entertainment. So in my former career, we used to do a lot of this. We'd take brokers out from the financial side, brokers, analysts, all that good stuff. We take them out, basketball game, baseball game, dinner, whatever it happens to be. Now in that arena, the finance institutions had their own rules on top of what the IRS says you can deduct in terms of their own rules on how much you can spend. But the way the IRS says it is that most meal costs are only deductible up to 50%, but certain types of meals, such as a meal provided at an office party, are 100% deductible. And this is something you want to have your receipts on for sure. Travel expenses. So this can also be a big one in our industry, right? Like majority of our properties are outside of where I can drive. So I've got to get on a plane, right? Stay in a hotel, rental car, all that stuff. This is a travel expense and it can be deducted. It says you must also be away from your tax home for longer than a full work day. And then types of deductible travel expenses include airfare, tolls, taxis, and lodging. And then next is interest. So think of, small business loan, you make interest payments on that you're borrowing from your lender. Those interest payments are fully tax deductible as long as the loan is used to cover business expenses. And we all know that interest, on certain loans for properties can be. Obviously, you can FHA, PMI insurance deductible, and the interest is deductible up to a certain point as well. Next is bad debt. So bad debt, say you lend money to an employee, you lend money to a vendor, and they never pay you back. You can claim that back as bad debt and deduct that from your taxes. So this can be loans to clients, suppliers, distributors, employees, credit sales to customers, business loan guarantees. Now, taxes. That's right, taxes. You can deduct taxes from taxes. It does sound strange, right? But the taxes you incur, I'm reading this straight from here in the IRS, the taxes you incur from just running your business are deductible. The taxes might be federal, state, and local income, real estate, or sales taxes. Your employer taxes, such as the employer share of FICA and FUTA and state unemployment taxes, are also fully deductible. Employee salaries. In general, the employee wages are fully deductible. This includes bonuses, commissions. However, the deduction does not apply to sole proprietors, partners, and LLC members because these individuals are not considered employees. So for, syndication entity, that there's no employees there, right? Not in that entity because you're just LLC members. Now, any employee benefit programs, you can deduct certain of these programs like education assistance, dependent care assistance, life insurance adoption assistance, or qualified retirement plan accounts. Employee gifts. So employee gifts are 100% deductible up to $25 per year per employee, according to the IRS. Not a big one, but something you want to keep in mind. And number 20, 2 more to go, contracted labor. So this is not that big in our space, but it can come up. So if you use any type of independent contractors or freelancers as part of your labor force, the cost of hiring contracted labor is fully tax deductible. You must issue form miscellaneous 1099 to any contract worker receiving $600 or more in that given tax year. And then 21 is legal and professional fees. So we definitely use a lot of those in this business. And so if you ever have to hire a legal or accounting professional for your business, you can deduct 100% of their fees. And we're definitely using those, both attorneys and accountants. So I hope this wasn't too boring. I know taxes usually glaze over a lot of people's eyes, but this is one that's important. Kind of boring, but important, right? Because Finance Fridays, every Friday I get on here to try to share with you some type of tip, strategy, or kind of where I see things going that can help you with your money so you can keep more in your pocket. Thereby, you have more to deploy and invest into assets that can then produce and create the life that you truly want to achieve. And this is one of the best ways to do it, is know the tax law. And I'm not saying you have to know it and help, but you need to know enough so that when you go to your CPA, you can tell whether you have a good one or not, right? Because this is a great way to keep more money in your pocket. The less you have to pay for Uncle Sam, because that's generally our biggest expense in life, is our bill to Uncle Sam. So if we can keep more of that, we can do great things with it and create the life we want to live. And the great thing about investing in real estate is like, I'm not here saying like we shouldn't pay any taxes, right? Because we live in a community that provides us a lot of stuff, provides us opportunities to do this amazing stuff. And of course, I want to give my fair share. But I also want to not give more than I need to give so then I can go back, invest in real estate, invest in other businesses and assets that can then produce more for me. And then I can give back to the things that I want to give back to. So I have more faith in myself, giving money and giving my time to help out things that I care about than to give it to some bureaucrat that's where the money's not necessarily going to go to what can make the world in our country a better place. And like I always say, we pay a lot of taxes already just on real estate tax. So it's not like we're not paying. We're just keeping more of the income we're making from these assets so then we can go buy more, provide even more places to live, quality places to live, right? Because we go in and we fix up these places. So more money to go acquire more assets to create more quality living spaces for individuals. And then we can, then produce more income that we can then take and give back to our communities directly. And it's powerful. So I know this was probably a boring episode, but it's important. It's important to get our money right. All right, everybody. Thanks for tuning in as always. Hope you got some value out of this. And as always, if you did, please share with someone else that you think, can get value from this show. Greatly appreciate it. That's how we get out to more eyes and ears. All right, everybody. We'll catch you on the next one. Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course, share it with a friend who needs it. See you next week for another great show.